Everyone, welcome warmly to CFA Special Issues. The meeting is recorded for people who are not here. I should always remind you when something is recorded for privacy issues. People at Hebron are with us. You guys can hear me? Maybe? Yes. Okay, good. Basically, what we are doing today is looking at financial analyst reports. It's a standard format that they all use. We have quite a few past reports. Some of them are prepared at Tübingen. Some of them are prepared at Hebron. So it's the work of your past students, classmates. Also, there are a few winning entries in CFA that have internationally won. And I have put those on internet too. Our idea is to read one of these reports at least, just read them quickly, and get an idea of the formatting, what goes into it. It basically uses all your business education. The homework asked a little bit more, said update it, but the grading is quite gentle. The idea is that you read one and you are familiar with one, and then you put all your effort in making your report, which is due the first week of January, a time that most of us are in vacation, and it's due on Sunday. Usually we return that Monday, but we have done this every year. What I would like to do is give the podium to the students one by one and sort of talk about what you have read, if you have questions, comments, and maybe we learn from each other. And as I said, you are among friends, so this is not harshly graded. The same goes for Tübingen students. You can take the podium one by one and talk. Who wants to be my brave volunteer, the first person who talks about their assignment, their homework? Can do it. Excellent. Can you do it from my machine or bring your machine here and talk? So the Tübingen people can see it too. I can give you a memory stick also, or yours, and then we can share the presentation here. Yeah, if you don't want to share a document, you could just talk here. No, so I need to share it. Yes. Here is a memory stick, and then we can take it from there and put it here. And this one projects for Tübingen too. Okay. Otherwise, they won't see it. And we try to give you a face once in a while too, so someone is talking. If you can put it on that memory stick, then we put it on this laptop and then we share it. Okay. I think that's the best way. Then you would, people would see it. Showing this is difficult. Okay, so I have to download it first as a PDF. Yeah, or anything that, or you can download it on my machine if it's. Nah, it's on Google Docs. That's the thing. Okay, we're doing a little bit of technical thing here, getting it from Google Doc, and then we are going to try to share it with you guys. And feel free to interrupt us anytime you like with questions, comments. If someone from Tübingen is ready to go first while we are setting this up, we could do that too. This might take a few minutes. Yeah. Anybody up there? Oh, there we have Maren ready to present. Yes. We can't hear you, so let's see what we can do about this microphone.
You can't hear me?
Yes, we hear something.
Okay, so can you hear me?
Yeah. You want to share the document or?
Okay, I wanted to ask a question, but I can also start with sharing, of course.
Maybe we do that first and then we go to questions.
All right, so let me know when you can see the screen.
You're seeing things? Very fancy things?
Yes, we can see it.
Okay. So let's start.
Here we see rearrange videos in the stage. So
Pardon
maybe
me?
you got to say got it, and then we can see your presentation or something.
Again, please.
Oh, that's my fault. Okay. I'm not very sophisticated with computers. People help me here. Here. No. Then we see. Then you see my screen. So. Oh, I got to say got it. Okay, I got it. Excellent. I got it.
Okay.
Yeah, this is more trouble for an old man. I get out of the way and look at this myself.
All right. So shall I start or?
Oh, please go ahead. Feel free to get started.
Okay. So basically, I've updated the figures for 2021 on the basis of the annual report as a first step, and then I created the charts newly, and also some of them added them, which weren't in the report before. And to be honest, I didn't realize that there is an Excel sheet behind the charts. So in the end, I realized it, but then it was too late. So with an Excel chart in the background, it would have been much easier to update all the figures. So that's why I've only updated the figures for 2021 and took the other figures from 2022 on as given.
Of course, that's excellent because that's our purpose. We want to see what is in this report, and then we discover things like Excel sheets that are behind the graph. But we are also seeing simple things like the stock price for today is given, and then a tracking number and a little bit of description. And that's exactly how they do their reports, and our final report should look like this too.
Okay. Yeah, and I mean the group before did a good job on estimating. So yeah. Okay. And then I of course also updated the text in here. In fact, their estimations for 2021 weren't that bad. They were quite the same as the actual figures, and I slightly adapted the fair value share price, which is around 157 according to my calculations, and also the weighted average cost of capital, of course. It follows a bit later, so let's look at the WACC. So in the annual report, it was written that they calculate with a WACC of around 7% for the following years. And I think the group before had like 6%, so there was only a slight change. And yes, basically I just updated the figures and text, and which I additionally added was sensitivity analysis. Like here, where you can see change in WACC and change in the terminal growth. And then according to the scenario you pick, you have different share prices, which are here in the in the white cells. And the one I calculated with the DCF model is the one with the terminal growth rate of 3.85 and a WACC of 7% as given in the annual report. And then we have a predicted share price of around 249 euros.
Let me rudely interrupt here and say a few things before I forget them. One is valuation. We are going to have a lecture on valuation. So some of these may be for some of us new, and for some of us we may need a little bit of refresher, and for some of us it's an old hat. But when that lecture goes, I'll make an announcement a week ahead or so and do that lecture. That lecture is already on Ilias, so you can look at it. But valuation is pretty important, something behind this calculation. The other issue that I want to mention is Bloomberg terminals sometimes give you this full analyst report with buy and sell orders. Now it's about a year that we have a Bloomberg terminal here in Heilbronn, but hopefully the students here would also cooperate with you, and once they get their hand on it, everybody can sort of look at what is there, because that might push us ahead too. In the past, CFA would give us Bloomberg access, but they would block reports that are generated, which we can use for competition. But I don't think the one that we have at university has anything blocked, but I'm not sure. I'm not quite sure how getting our hands on that Bloomberg works. I'm going to send some emails and try to figure it out. Now, as far as I know, we don't have Bloomberg at Tübingen, right? But we have something else. Go ahead.
No, we don't have Bloomberg at Tübingen. But I think the professors maybe have access to Refinitiv or Refinitiv,
Yes.
but not the students, I think.
Yeah, that's even better. I can ask around from the banking department and see if there is any ways to get our hands on that. We have Reuter Thompson in the library, but that requires a reservation. And in the past, people were able to make reservations and take that out on a laptop. That's quite expensive too, and a couple of professors usually pay for it from their budget. But anyways, any data provider that you can get your hand on would be helpful. I'm sorry about the rude interruption. Let's continue, Maren.
Okay. Yeah, let's go over to the investment summary. Because here the most things have changed. So I still have a seller recommendation with target price of 157. Here in this figure, you can see the different share prices which resulted from the different valuation methods. Here we have the valuation method per multiple with the owned value, the enterprise value, and the EBITDA, and here with the revenue as multiple. So very low share prices, and then we have the share price which was calculated by the DCF model, which is hugely higher than the other ones. And yeah, well, the difference might come from the WACC, from the weighted cost of capital, but in fact you can, or I took the average of these three share prices to take the recommended target price of Hapag-Lloyd.
Wonderful. And another announcement that I made very early on is that this meeting is being recorded for the benefit of a few people who couldn't attend. And so also for privacy, please know that it's being recorded. You all feel free to continue.
Okay. Then in the appendix, I updated all figures. Here for the components of the discount cash flow model, I calculated the beta factor and did also a regression. So I regressed the returns, the daily returns of Hapag-Lloyd and of the DAX sector, transport and logistic, because I thought it was a good benchmark for it. And as you can see, it's quite a good one, I would say, with an R-square of 0.11. And then I took the beta and adjusted it with the Blume adjustment. And well, it's a quite easy adjustment, but I think a very reasonable one, which is also used, yeah, really in this sector. So yeah, as risk-free rate, I took the 10-year German bond yield, and with 2.3 3%. And for the market return, I took the annual return over a 14-year period from the DAX sector transport and logistics.
I have a question.
Sure,
Yes.
please go ahead.
What do you mean with the Blume adjustment for the adjusted beta?
The
Because I
Blume
never heard that.
adjustment basically weights the normal beta with 0.6, so with 60%, and adds 1 multiplied by 30%. So the beta is weighted much more than the 0.1.
Okay. And is this a usual method in valuations of the CFA, or?
I don't know whether it's the official method of the CFA, but it's one very or one popular one, which is really used in practice. So I thought I go for it.
Okay. And what was the source of the 10-year German bond yield? Where did you get the rate from?
From the Deutsche Bundesbank.
Okay. So if I would buy the bond on the secondary market, or is it the yield if I buy the bond from the Bundesbank directly, or?
I think it was from the Bundesbank directly. Yeah.
Okay, but for a normal company, I think it's impossible, or is it even possible to buy the bond yield, the German bonds directly from the issuer, or?
I guess some approximation is involved. What we want is a risk-free rate, and we usually use the German bonds for our risk-free rate, and then the maturity matches 10 years or whatever we need in the valuation.
Okay.
And there is always a little bit of hand waving involved. Or at times you could look for risk-free rate rather than looking for German bonds. And again, if you have access to a Bloomberg terminal, it will give you the risk-free rate to use. But some of the questions you're asking is what we want to ask each other. And the classmates would help you. Our competition is not cutthroat, so we'll help each other both in Tübingen and Heilbronn. We ask each other a lot of questions, and our purpose is learning. You also have an industry mentor, 2 different ones, and my recommendation is to start bugging these people early on. So get in touch with them and ask them questions, and then they would answer the question whether this methodology, for example, is used in the industry. But what I have provided you is a lot of past reports to CFA, and you could simply see if these reports have that sort of analysis that we are talking about. Adjusting beta for debt is for capital structure. Debt in the capital structure is very standard, but other adjustments may need some explanation.
Yeah, I also looked at the reports from the winning reports from the last years, which was, for example, the Norwegian Business School or Illinois, and downloaded them from the CFA. So there you have also a very good reference to compare and get impressions.
Well done, and you may want to put those on Ilias too. You can post there, or if you have trouble posting, let me know. And I just posted about 6 reports from the past 2. Some from Heilbronn, some from Tübingen, and some winning reports.
All right.
Other questions, comments? Let's go to the next report from Heilbronn. It's on memory stick. Yours is ready.
Have you already opened it? Or?
No, but it's down here. You can open it. I didn't want to mess with it. It's one of those.
Yeah, one should be.
I think we can share this.
Yeah, I have to open the other. Yeah, it's a bit hard to see, so. Now I have to share the screen.
Please.
All right, and now I have to. So in consultation with the professor, I actually took a new company, or at least one that wasn't already in the report, with Netflix, as you can see. Is the camera on? Can they see me or not?
They probably can, yeah.
Okay, so then I also talk to the
Yeah,
camera.
yeah.
And yes, obviously it's not like a full complete report, as you can see, but I based it on a model that I built, a discounted cash flow analysis. That's the reason why I'm going to start with this, because the rest of the report is basically built around it, and I think that's also practice in the industry. I don't want to go through all the line items because that would maybe be a bit boring and lengthy, but basically it's a street-based DCF model, which means that the estimates I took, which I will show in a second, weren't mine actually, but from equity research analysts. So the growth estimates, for example, the revenues and etc. weren't actually myself or mine. And yeah, as you can see, just like the student before me, I also had built out 3 cases, which is also quite standard. You can see it up here. A base case, a bull case, which is like the optimistic case, and then the conservative case, which is the more if things go wrong kind of case. Go down a bit, then you can see I also obviously had to calculate the WACC. Actually, I did not do it myself. I also used estimates. But as you can see for the different cases, so the conservative case, for example, uses a higher weighted cost, or a higher weighted cost of capital. So if the company takes up new debt, they have to pay higher price than, for example, in the bull case, which obviously then is not as beneficial for the valuation and will lead you to a lower implied share price. And same for the TGR, the terminal growth rate. That's basically the rate of growth the company will ultimately achieve. Also, in this case, I used different numbers. As you can see, the optimistic case uses 3%, the conservative 2%. And yeah, then we can go down into the actual forecasting. So first of all, you can see that you have to forecast or model the financial statements. So the income statement, cash flow statement, and also I think that's it. That should be it. And you obviously you use as you can see up there historic numbers. So I did it from 2012 on, and then went out until, and as you can see right here, that's the forecasted part. That's the most interesting part, or thing that actually then predicts the share price until 2027. But for the full DCF, which you will see in a minute, I did it until it's a 10-year DCF, so until 2031. And I think, at least for the students in Heilbronn, that's all quite new. So if that's for the Tübingen guys not so new, I'm sorry. But I think if you spend a bit of time with that, with the next few items, it will actually be very beneficial for all of us. So as you can see, you then take things like, an example, D&A, which is depreciation and amortization. In German, it's Abschreibung und Amortisierung. So non-cash expenses, basically. And first of all, take the old ones or the historical ones. You can all gather them through the financial statements, which are typically published on the website of the company. But then you also obviously have to build out a forecast for the next or the upcoming years. And how do you do that? For these items, it's most commonly done by just calculating an average for, let's say, the last 6 years, an example, if you take D&A. And then build our forecast based on the average of the last 6 years. If there's like a specific trend which you can see or spot, then you take typically a weighted average already, so that the latest numbers are valued higher or weighted higher, and the model is more accurate. And that's basically done, or that's a method to do it, not the only one obviously, but it's very typical for a D&A, an example. Then yes, obviously capital expenditures. So basically investments or expenditures you take for you have to make for long-term gains basically. So not operating expenditures also have to be considered. And then also what's important is the change in the net working capital. The net working capital is basically your current assets kind of minus a few other bits which are not that important, but and minus your current liabilities. That's then the change in your net working capital, but you can look that up. I also marked the table for, but it's not visible in the PDF, unfortunately. And then you have to get to the actual discounted cash flow analysis, which you then can see is based on the last, I think 10 years and goes out on the right one. So all the yellow marked numbers are actually edited 10 years in advance. And then once again, you have to make a revenue estimate, which can be based on an example, the management commentary. So basically their guidance, their long-term guidance, but also once again on historical averages with Netflix. Netflix is still a growth company, although it's obviously slowing down quite dramatically, which caused the share price to plunge over the past year. So with growth companies in general, it's always more difficult to actually estimate their revenue 10 years out because it's quite, let's say, volatile. So the method just using it or doing an average or a weighted average maybe is not the best one to do it. But obviously that's different from company to company. And yeah, then I basically did the same thing. And you always have, that's maybe not also important. If I talk about the average, I talk about the growth rate, obviously. And with other items like depreciation and amortization, it's based on the percentage of sales. That's usually the measure that's used for that. That's the same thing for the EBIT. And taxes, obviously taxes, you can just look up the historical tax rates. That's usually not a big part. And yeah, then finally I should come here, yes, to your finished result. It's gonna have to go to the right, I think. It's a bit hard to see. So then we have, at the end of all of this, we have the unlevered free cash flow. Unlevered basically means that we not estimate, but we talk or think like they're just not debt funded. In the case of this gives us less exposure to the capital structure. And then you can see right here, I have things like the terminal value, the present value of the free cash flow summed up that you can see right here, estimated 10 years out. And then at the end of all of this, you have to take the number of outstanding shares, which are available in basically every quarterly filing or just on any financial website. Yahoo Finance, an example, you'll find these. And you have to divide them by the connected equity value, and then you will get an implied share price, which then is down here. Obviously, this is a very, like I already said in the beginning, a so-called street-based discounted cash flow model, which is a bit more simple, or you make it a bit more easy for yourself than if you do it like line item by line item. That means that you look at different revenue segments and all of that stuff, and it will take a bit more time. And is recommended if for the challenge with Software AG, I wouldn't do it just on street-based estimates, but do it in more detail, kind of. And then I included, as you can see, that's now the Word document, which I copied the style kind of based on the existing reports already. I included a table with the most important assumptions, obviously, and then the table which displays the DCF, and then further down did the usual things like, I won't go through all of this because that might be boring, things like the business description, segments of the company, then obviously also included some graphs, for example, for the competition. I think that's also quite usual. And then I think the most important part, or one of the most important parts, if you read a report like this, you want to know why the analyst came to the conclusion of whatever conclusion he came to. And the most important thing then are the potential growth drivers or revenue drivers or segment drivers. And that's the part I find most interesting, because that then shows what he thought behind his analysis. So I also included that. And then the most recent thing, which is maybe also quite interesting, Netflix actually reported earnings, I think 2 weeks back or something like that. So after I did the DCF analysis, and these earnings calls are always quite interesting because then you will also get guidance, not just for the next quarter, but maybe also long-term guidance. They update you on things like, in Netflix cases, how they want to capitalize on password sharing and kind of eliminate that, but also establish in Netflix cases an ad-supported version, which will basically give them additional revenue streams. And then you obviously have to factor that into your model, which then might change your estimates. That's also the reason why a model is tendent or goes under the contingent claim argument, I think is the name, which basically means that it's always just for one time and you have to go back to the model and update it for basically everything the company says. Yes, and then I think, yeah, I added some of the commentary, but that might not be that interesting right now. And one last chart, which I also find quite interesting in Netflix case, is the, but that obviously depends from company to company. This is subscriber count or paid subscriptions, as you can see, basically looks like an S-curve by now, which also, so basically the growth is slowing a lot, as you can see right here. They are not gaining as many subscribers anymore, and that's probably the reason why they have to establish something like an ad-supported version, or have to cut or limit password sharing to gain additional revenue because the growth is stalling. Yes, but obviously you have to, or in the final report, there are many parts missing in my report. In this case, it's just like a shorter version with the or the most interesting parts, probably in my opinion, but things like a sensitivity table, which the student before showed, I did not include that. But yeah, I think that's basically it. Yes.
Excuse me, I have a question.
Yes.
Can you go back to the slide where you compare the overview of the valuation? So I think it was a slide where you have the base case and then the
You mean
bull
the
and the
model,
bear case plus
the
minus.
Excel model? Yes.
Yeah.
Yes. Yes. Go on.
Yeah, I want to see the slide again so I can ask my question because didn't understand that fully.
Yeah, I
Yeah,
think.
there, yeah. Is it usual to just go by the percentages of revenues or just to estimate taxes? Because I originally thought that you could imagine various scenarios and then come up with different revenues. So a conservative case would be, for example, not only that the revenues go down, but I don't know, you may have internal problems or you may run into a different political situation or whatever. And is it normal to just rely on I would not say easy, but to shorthand estimates instead of making a detailed analysis of different cases on how to come up with revenue figures?
Are you now talking about the whole model or just the revenue figures?
No, so you have the base case and you
Yes.
estimate your revenues.
Yes.
And then you would say, okay, the conservative case versus the bull case, you would just, for example, add 120% on the revenue, so you come up with the bull case, or with the conservative case, you would just go with 80% of the revenues, and that's your conservative case. And
Well,
I would say that's it looks shorthand because you could imagine a more detailed way to come up with different revenues.
well, yeah, first of all, you have to keep in mind that at the end of the day, we come to the implied share price by guessing or calculating the net present value of the future cash flows in terms of like time span. So in this case, 10 years. So we sum them up and then discount them. So our discount rate is the weighted average cost of capital, which you can see here, which obviously changes from case to case. And as you can see also right here, the conservative case has built in another revenue expectation from 2023 to 2024, and then also from 2031 onwards than the base case. But I think what you mean, bull case or the other cases, what you mean is that you like build out different kind of more specific scenarios. I think you mentioned things like political issues, but I think if you think of it like that, how would you do that exactly? Because then you would.
I was thinking about the methodology. So for revenue 2023 and 24, you can say, okay, it's 2 years and we know what's going on currently, and we could consider different scenarios and then come up with revenues. But as you can see in your analysis, you just took the percentages from the base case, and I wanted to ask if that's what one usually would do, or if that's typical. Or
I don't really understand your question, to be honest. Maybe you can be a bit more specific.
so you in the base
Maybe I
case.
can address that question. It's very usual to use a CAGR, which is essentially a growth rate. And you grow your sales by this CAGR, and you use that in forecasting.
Yeah,
but
that's
it is,
basically
of course, a naive case. You could incorporate additional information. For example, we know from our salespeople that a major customer is dropping us and not buying as much, and what you were referring as political situations or other factors that affect us, we can incorporate them, but that's more rare. It's very customary to just do these naive estimates of using CAGRs, and usually the companies do that themselves. They give us pro forma accounting statements where they have forecasted the future, incorporated the growth, and those are usually trustworthy, because if they don't reach these goals, their stock price dramatically drops, so they don't exaggerate. But when we are building a rosy scenario and building a pessimistic scenario, we may just go by a percentage reduction, like 80%, as it is done here. This is fairly standard.
Okay, thank you very much.
Yeah, because everything, the more details, the more data you add, the more complex it gets. And I mean, if customers pay for that, yes, but if not, I can assure you that it's they won't waste any time in this, or waste is maybe the wrong word, but put too much effort for it in regards how much you get paid for it.
I also have a
But
question.
obviously you can do that. Yes.
If you use the CAGR to forecast the figures, do you take a rolling one? So do you take it over like 5 years and then roll it, or do you always take the same 5 years in the past?
I mean, you could do that, but in this case, it's just done. We are on basically a simple average in combination with. It's also not like in this case. I also looked at the equity research. So an example, if you look at 2027, an example, you can see that I'm coming from like higher growth rates to lower growth rates. That wouldn't make sense if I use an average, also rolling one in terms of sales growth. So you have to factor in, I guess, or use multiple analysis kind of. So you could do what you say, but that would also include maybe things like how the face of the company is in, basically. If I take Netflix, it's quite reasonable to think that they maxed out or their revenue perspectives, their growth rates. So that's the reason why it declines or stalls at the further we go out, basically. That answers your question, kind of.
Yeah, and from my side, that's a very good question. You basically incorporate news or information that you have from the company. So this Wednesday, we get a chance to ask questions from the company. But if our company was Netflix, we know that quite a few subscribers dropped the service. And now we know that they are starting to get these subscribers back. There is growth in subscriptions. And we also know that they are starting advertising, and that would bring a different stream of revenue. So you may use all this information to have different KGARs for different years, but you have to justify your assumptions and sort of explain it.
And maybe one thing I can add here, the average method is more often used for line items like your depreciation and amortization % of sales, because that typically stays around the same at least, or there's no like clear, or if there is a clear trend, you can use in weighted average. But things like revenue, because that's not done via an average typically, in terms of the forecasting. It's more like as you for example, you can use you can look at the whole total addressable market of a company, or the part it's operating in, and then look at how much market share it already got, and then build out estimates how much market share there's still to gain, kind of. And that's how I would, or how you do build out in revenue forecast. That's maybe if I didn't say that correct, it's not done on just the averages over the past few years. It could be, but then more on like established companies with normal growth rates. Normal growth rates mean basically that they are quite similar to the GDP growth of the country most of its revenue is from. But for a company like Netflix, which still is a growth company, it's more usual to look at things like, an example, the total addressable market, their overall market share, and guess out how much there's still to gain. And then obviously, once again, you can build out a conservative case, a bull case, and then that's up to you. Hope that helped a bit.
Other questions, comments? Okay, let me take the podium. I want to address administrative stuff about grading, because that's always an important thing that we consider. We have 5 members that are participating in the competition, and a number of others who are just taking the class for grade and not participating in the competition. Either way, the grading is relatively gentle. This assignment number 1 is something that I want you to save your energy and not go home and give a lot of energy to Netflix or some other company, but save your energy for the competition, for the firm that we already know and we are considering. But obviously, each student should individually post something about this assignment number 1, and that something should tell me that you have looked at one of these analyst reports, maybe massaged it a little bit, maybe you understood it. We had 2 presentations that by far exceeded my expectations, so I'm very happy. Maybe we get another 2 presentations or so. Everybody doesn't have to present, but you want to post something here for grade, which is called assignment number 1. After that, we go to our next event, which is Wednesday. They changed the time on us, and it's not up to me to record it because CFA would broadcast it. It's, I believe, from 2 to 3:30, from 1 to 2:30. They have not sent us a link to click on it, but I'm sure they will. They did today. Okay. Yeah, today I've been teaching non-stop, so I haven't checked my emails yet. So Wednesday, wherever we are, we click on that thing and we listen. If you have some other appointments, at least listen to part of it and talk to your other classmates. But this is a very important part of our job, because that's the only time we get to see some of the management of this company. Some companies in the past have been very generous. The chief executive officer have come and treated us just like people who analyze their firm and shared a lot of information. But typically they are less generous, and they send the propaganda guy or gal. That's basically the investor relations PR person. But still, as a student or faculty, this is the only time that we get a lot of information about the company. So and please come there, listen to all the questions that other groups have, and ask your own questions. I have a question on the floor. Yes, please. Yes, as soon as I get the link, I'll put it on Ilyas. But yeah, that's a problem too, because the 5 of you who are participating receive the emails. But also, please be generous about sharing with classmates who are not in the group. Yeah, you just click there and nobody controls. Yeah. They go team by team, and they would say, for example, team where how you ask your question. Sometimes they go alphabetically. So we are H for High Brown, we're first, and then Tübingen is a little later. But depends on the time they have. There might be time for only one question, but the questions should come from a student. So someone, one person from the 5 should be ready to speak. And you pretty much give the question that you have given to CFA, but there is time, there is a chance to massage it a little bit away or say it a little differently if you're not happy with it, if it doesn't roll off your tongue the way you like it. But we don't want to surprise them with a question that they don't like. Part of this is, again, the PR guy wanting to limit questions to things that is acceptable to the company, that is not too embarrassing. So they may not take some questions that we had. Sometimes there have been extra times, so they went a second round, asking all the teams one by one to ask a question. And sometime at the end, they said, does anyone have another question? And of course, you guys can ask a third or a fourth question if that comes and you still have burning issues. After that, basically, we write a quick report. And the game is to give it to your industry advisor and try to get some input. Some of them provide a lot, and some of them just give you a few PDF files about how to do things. I will also read this and give you a feedback for both groups. But the deal is that this has to be all the student work. That it shouldn't be the work of the industry mentor or myself. But we had industry mentors in the past that took their group to a coffee house the night before and sat down and produced a winning report. Well, we see if we get one of those A types, more power to you. You can, you know, go together and sit down and do a report. I don't know. Have you guys contacted your advisor yet? Industry advisor, Tübingen team?
No.
No, usually we do later. How about your High Brown team? That's common, but you guys did well. It's good to get them early because when this, we usually get ready with our report close to Christmas, and these guys go on vacation and don't answer. But if you start bugging them now, in a few weeks they will answer, hopefully.
I have a question.
Pretty much stuck with what we have, resources that we have, and we deal with that. Again, the competition is not do or die. And the grading is gentle, but this class ends up being more work, and more work in next 2 months, November and December. And you're handing in the report January 7, and for all practical purposes, the class is over January 7. And that's a Sunday before you come back from vacation, I think. But after that, there is no other task unless you win. And if you win, then we'll deal with what to do. Yeah, and you get a grade for this period from me. So that's the story about the grade. In the past, there haven't been any complaints about grading. And of course, there is a safety net, but there are 1.0s and 1.3s and 1.7s, depending on how much you contribute to the group.
I have a question.
Yes, please.
The report we have to hand in after the 2nd of November to the advisory. Is it like a first draft of our report, so that the current status of our work, or how should it look like?
Yeah, a first draft, but I modified that work that you have to, you don't have to. The only thing you have to is on January 7th, you have to give a final report to CFA. The other reports are for our internal use. Obviously, they would have a grade attached to them, but I'm open to extending deadlines and sort of pushing things, but it's good to do these things quicker. And then I have some time to give a feedback, and hopefully your industry advisor would give a feedback too.
Okay, so it's voluntarily.
Yeah, it's voluntary, but it still has some bite of grade to it, right? And it's graded. But right now we have task one, and the purpose of that is that you have made yourself familiar with this standard format that analysts use individually. So each person looks at that and maybe massages a little bit of it and posts it on internet where we can all see it's transparent. And of course, we got two very good reports, including yours today. But everyone doesn't have to produce at that level. I want you to save your effort for the competition, right? But we got a good discussion about what these reports are. And of course, valuation is at the heart of it. Maybe we have one or two more brave volunteers who want to add to what we heard today. I'm looking that way. And do we? No, we don't. Okay, I'm looking at Tübingen people. Do we have another one that someone else who wants to add? You don't have to, but if you have a burning desire to share yours.
I can do something if you want.
Yeah, feel free. Go ahead. The podium is
Okay.
yours.
Can you see it?
Yes, we can see it. Also, before I forget, you guys can all keep in touch with each other. And of course, there's a mass email that has all your name in it. And if the two groups want to be in touch, I have no problem sharing your emails, but then you got to let me know because of privacy issues. But if you want to share emails, I can share it. But right now you have Ilyas for each university and you have mass email for each university.
So, well, it happened to me the same as Maren because I didn't know that there was an Excel file inside the chart. So I just made my own Excel file, which was much simpler than the other one. But in the end, the thesis didn't change because the assumptions were right to me, and I mean the business description, I didn't have to change anything about that. Also, the shareholder structure was the same, and the management as well, but because I looked into the annual report, and maybe the best part is in the Excel, so I'll just go there. Sorry for the Spanish, but okay. It's basic Excel with some assumptions that, if I tell you the truth, I was very positive with the firm in the base case and also in the bear case. But as you can see, the assumptions were based on the TEU growth, the freight rate, also on the cost of goods sold. I didn't mention the price of oil here. I did it in the report. I thought that it was very important to talk about it. Also, it was very important to mention the current economic situation because of the positive beta that Maren talked about. The company is really dependent on the current situation of the global economy, as they as they are a shipping company. But in the end, it's a basic model, as you can see, and the final share price that I got with this model was 179. But this is the maximum entry price in order to obtain a 12.5 return. That is the weighted average cost of capital, because the model that I used is was used with the exit TV free cash flow, the terminal value, and an exit multiple. But you can see that if I change and I put the bear case assumptions, we observe that the revenues go down, and also in the end, the maximum entry price would be 155. So okay, I don't know if you can see it, but it would be a sell recommendation, or in the bear case and also in the base case. So I don't know what else I can say. I'm a little bit nervous because it's my first time talking to the public about my own model. So maybe if you have any questions to talk to,
But actually, it's very
ask.
good that you shared this. Please go to the first page of the report. Let's see if it has a name on it.
You mean the report?
Yeah, the report itself. Okay, yeah, first page, very top when it says CFA. So go back to very beginning, please. There we go. And this is the past report from Tübingen for the competition that we did last year. And we have exactly this report from Heilbronn for the competition that we did last year. So it kind of tells you what the students did last year. And I have both of them on Ilias too. The nice thing about this is that some of these students are still hanging around. And I can dig their email for you and sort of ask them if they want to talk to you. But that's the one thing that CFA recommends, sort of this institutional knowledge. Past students have done the work and done the whole thing, and you could ask them questions, and it's good to see their report. It also says, hey, this is not something that Albert Einstein did. It's something that the students like me last time that this class was running did, so I can do this. In that sense, it's good too. Other questions, comments? I think these three reports are very good and enough for us in terms of, more than meet my expectations in terms of figuring out what's a standard report that we're writing and how it's written in the past. Again, I want to emphasize that this is homework one, so everyone should do a little bit on it, but please don't stress yourself to the point that this takes several days of your time. Read one, make yourself familiar with, make a few changes, few comments, and as I said, the grading would be very civilized. The only way to get a bad grade is not to submit one on Ilias. You want to post it so everyone sees, and then maybe you have a comment or a question that comes up, and you see what has to go in the report, which it's not just valuation and finance, it's all your business courses. So that's also useful. We pretty much are getting to the last half an hour of this meeting. So if there are questions, comments, other things I should address, ask me. Wednesday, 1 p.m. is our next big deal. I usually send you mass emails. There will be a lecture on valuation, maybe in 2 weeks, approximately. I will send you something, but next week we have this one event, then it's nice to have another event the week after or 2 weeks after or something like that. Usually I like to schedule it at this time because we have an official class time in and classroom in Heilbronn at this time, 6:30 to 8 p.m. But we can tape it and have it available for those who can meet. And 6:30 to 8 is sort of the graveyard shift, so a lot of you would be able to attend, right? At least toward the end, I don't know. Other questions, comments before we go home? Thank you so much for attending. It's very good to see all you, you know, over the internet and in person. Take care of yourself. See you all hopefully Wednesday.
Bye.
Thank you. Bye bye.
Thank you.